Hello everyone and welcome back to Element Portfolio for another market update. My name is Marcus and this is my portfolio and I am recording this on the 4th of February. So today we're going to talk about the same concept as last time. So we're going to start talking about a weekly summary. We're going to go over the past week news, the market sentiment, then we're going to do a market update and a summary, and then we're going to talk about next week. So to begin, this has been an intense week with a lot of economic news. So first we got the FOMC's rate decision, which was that the Fed is going to hike the rates with 25 points. And also Powell, he gave off some dovish signals. However, yesterday, so Friday, we got the non-farm payroll, which was a huge surprise. So we get a result of 517K versus the 196.5K expected. And in a normal economic situation, in an upward trend, this would be a really good show of strength. But right now, this might actually be a negative sign, because this means that the Fed that is more focused on the working market right now, they see this huge strength. This means that they have more upside to increase the rates. So this might actually be a negative sign for the markets. However, we also got unemployment, which came in at 3.4. We got the ISM composite, which was 47.4. And then also we had another rate hike from the ECB with 50 points. And they also signaled that they're going to continue with more hikes as early as in March and continue. And then we get Euro area with the GDP, which was 1.9, which is less than previous. And we also get core inflation of 8.5 versus 5.2, which was the previous. And unemployment for the Euro area was 6.6. And after that, we also have the consumer confidence, which is the same as last time. And for China, we got the PMI. And here we can see that it has strengthened since previous. So all of them are stronger, with both service and composite being above 50. So 52.9 for service, and for the composite, we have 51.10. If we continue to the market sentiment, the battle between the bulls and the bears continue. The markets are getting more and more stretched, so we can see here that the fear and greed are getting higher. So it's up at 93%. And well, the question is, how much longer can this continue? So for example, at the moment, we see that retail traders, we can see here with the S&P 500 not long, they are decreasing the long position, which means that the short position is increasing. And this usually means when the retail traders are going more short or exiting their long positions, this usually gives room for an extra spike on the upside. So it's easy to be in conspiracy theories here, but usually the bigger players, they see where the retail traders are, and if they are increasing their shorts, the bigger players are going to push the markets up until the retail traders hit their stop losses, have to exit their positions, and then the bigger players are going to take the markets down. We're going to see about that. Another thing that I think, because I am still very convinced that this is a bear market rally, but one interesting thing that I heard in a podcast, a Swedish podcast called Antiloop, they were talking about the presidential cycles. And usually now when it is a build-up the year before the president election, usually there is external stimulation for the markets and the economy to be strong. I'm going to look more into this, so this was just something I think is worth mentioning for if you want to look it up. I am going to look it up more before. But I thought it was an interesting view, because that would strengthen that there's more fuel to this bear market rally. Because what we can see in the markets right now, that they are stretched on the upside, and I think they're due for a drawdown. But I do not think that this drawdown is going to be the big pivot that makes the market continues further down and aim towards new lows. I think that is going to come later. So maybe this week, next week, we're going to see some drawdown, just mean reversion more or less, but not as far as down to the mean, just balancing out this increase, and then we're going to see new highs, maybe not all-time highs, but new highs in this bear market rally. And then we'll see further down the road, I think maybe in spring, we're going to see that the markets go and pivot. But I also think an important notice here is how is the Fed going to react to the non-farm payroll numbers, because yes, they were showing off some dovish signals during the FOMC meeting, but now when the job market came in strong, we'll see how they'll react and what signals they'll give out this week. So interesting. I think that might also spike some form of drawdown, but then the markets might shake it off and then continue to go strong for a while. I think this bear market rally is going to continue further than expected, but I do not think that this is a bullish trend that we're going to continue for new all-time highs and continue strong. But we'll see. And I'm going to talk more about the USD later and also about commodities, so I'll continue. And here we just see for indices how the market is average for the 200-year look back, or not 200 period look back, and the average is above, so increase 3.38%. And if we look at year to date, an average across the industries that I'm following is almost an increase in 10%. So strong start. We see here volume is still around the mean and average, just stable. And we see that the VIX is still low. So we'll see. I think this will consolidate soon, but I think we're going to see when the markets eventually pivot, then we're going to see a big spike. Yes, so when it comes to indices, not much to add. I think that it is going to, like I mentioned, we're going to see a drawdown in this week, maybe next week, but soon. And then I think it's going to continue to go strong. So you see it's very stretched on the upside. We see here. Yeah, all of it is out. But so this is for the short term. We're going to see a drawdown, but then I think it's going to continue strong. And then we're going to see the big decline later. Maybe this spring, maybe later. And for industries, what we can see here, I'm going to go down to now when the market is strong, as it's been for the beginning of this year, that is also what we're going to see. It's kind of a revenge from the sectors that did poorly last year. So now when the markets are strong, they are also increasing, which we can see here for the year to date. For example, clean energy was going poorly before, and now it's going strong and it's increasing. So I think this is what we're going to continue to see now. Like as soon as with the bear market rally continues up, also the sectors that did poorly in the past decline, they are going to continue to recover. But after that, when we see the big decline in the markets, then this is going to pivot, and then the sectors that did well last decline are the ones that are going to continue to do well. And my bet, as I told you last update, is going to be the consumer staple, which is defensive, and I think this is something that's going to keep being stable. So there's something to decrease the volatility and continue with value. And we can also see consumer staples, it hasn't gone up that much, so it's just going to continue being stable, and then I think the finance sector, and then also energy. And even though energy is it is high, I think this is a sector you want exposure towards during this year. And if we look at rates, we see here that yes, we had two rates this week. So it was first the Fed, they increased rates with 25 points, but this just continue with the consolidation of the rates, and then we also had the ECB, which increased rates by 50 points. And well, if you look towards technical analysis, I know it's a good indication to look at, but still, like, in this case, it is the economic factors that is going to be determinant. But we see that there's some kind of bullish triangle that is, so it is charging, and then it should probably, like, the probability is that it's going to be an increase on the upside. But if we zoom out, we also see that during the past 10 years, the rates are high. And given the economy is more leveraged now than ever, or maybe not ever, but it is more leveraged. So the question is, how much more rates can the economy endure, and the US economy for that matter? So we'll see. So I think it's important now to see the reaction from Fed, from the non-farm payroll number, and see how they are going to continue to give out dovish signals? Are they going to try to increase rates more due to this, or are they going to start pivot? And I think that this might be like, we might get some negative signals now from Fed. This might increase the drawdown, but then the markets will shake it off, and then later when the Fed actually starts to pivot, that is when we're going to see the real changes in the economy from the rate hikes. All of this is lagging, so we always see it a lot later than expected. So when we're going to see the real effects on society, then when the Fed is going to pivot, or central banks are going to pivot, that is when the market is going to catalyst down. I think it's a likely scenario. I can't say it's 100% sure, because nothing is ever 100% sure, but that is the main track that I can see, which fairly high likelihood happening. But I think it's important now to keep track of the economic indicators and see how they affect each other, and look for signals that might change the markets negatively. If we continue with foreign exchange, we can see, I think it's better to look at this one. This might be a little bit too small for you. All right. So what we can see here since the end of last week is that the USD, the dollar, have increased compared to most of its trading pairs. And I think this is a reaction to, for example, the non-farm payrolls, that when that came in strong, then the market is going to expect more negative signals from Fed, which is going to be higher rates, and then also a stronger dollar. So I think this is kind of the markets taking that out in advance. But on the other hand, depending on how the markets will react, this might only be an initial reaction, but it might actually not be a real trend shift. So it's important to keep track of the dollar now in the beginning of next week and see if it's going to continue to strengthen towards the pairs compared to the other pairs, or if it's going to draw down and continue to weaken the dollar compared to the rest of its trading pairs. So it's a lot of thoughts to keep in mind at the moment, and it's many different paths, but it all says kind of the same thing. Like now, with the surprise of non-farm payrolls, we see that the economy might be stronger than expected, and this might make the Fed be more hawkish right after they have given off dovish signs. So So keep an eye on the dollar and see if this spike is going to continue or if it's just temporary. And I think we're going to get an idea of where the trend is going to continue in the beginning of next week. So, yes. We see here it is same for most pairs. Yes, and let's continue with commodities. And we can see here that metals, for example, gold, copper, platinum, aluminum, have started to cool down after a strong increase or after a strong start of this year. And we can also see that natural gas is continuing to go down. Crude oil is kind of in just testing off a bottom. And then we also see a small bottom starting to build here in cotton and in wheat. And I think it's better to zoom out to get a more complete picture. This might be okay. I go back and I do this. All right. So if we look with fresh eyes on gold and copper, I think, especially here in gold, I think this is a consolidation period. So I think now when we saw a little drawdown, it's going to continue here. I think gold is going to go up. Maybe not in the near future, but I think it's going to be in this range. It's a little bit negatively, slightly down. But then we'll see, depending on what's going on, that this might be enough to charge for gold to continue and set new highs. But not in the near future. Now it might go down for a little while and continue with this consolidation trend. Similar with copper, looks a little bit different. We'll see how it follows along. It's going to, because now it started to go down after this little spike. So yeah, keep an eye on that. And if we look down at, I'm going to start with cotton and wheat. We can see here that it started to look like a bottom in the 200 look back period. And we can see now that both cotton and wheat is kind of back at its base, where it took off during what I like to call the speculation spike of 2022, which happened after Russia went into Ukraine, attacked Ukraine. So, but now it has come down from these spike levels, and we'll see. My hypothesis, especially for wheat, is that this spring we're going to see the real effects from the war. And so now when it comes down from this speculation cycle, I think it's going to start moving up again. But we'll see how the harvest or the setting the seeds for this year's harvest that's going to happen in spring. I think that's going to be a crucial factor for the development of wheat, to see how much the war has affected the wheat production in Ukraine and how that is going to be in the rest of the world. And similar pattern, but not real, is for natural gas. And we can see that it still has room down to its bottom, and it's going straight down. And I think that depending on what's happening now it's getting a little bit colder in Europe, but I think that in this chart we can see that yes, natural gas should continue to go down, and then I'm keeping my eye on the level that is below the whisker here, which symbolizes the 5th percentile of the past 10 years. And I think that might be where natural gas is going to recharge and go up. But it's important there are so many political factors that are affecting this. So we're going to have to see how the weather develops in Europe now when it's end of winter and the beginning of spring. Are we going to get more cold coming in, or how is this going to change? And then I think it's also important to look at political decisions depending on everything that goes on with Russia. So my main track is, if it continues like this, then I think it's going to go down around this level here. But depending on what's happening in the political climate, then it might change drastically, so be prepared for that. So to summarize, markets have stayed strong but might experience a drawdown in the coming 1 to 2 weeks. I do not believe that this is the end of the bear market rally and that this rally might continue longer than expected. And I'm also going to look up this interesting pattern of presidential cycles and come back with that. And then also rates have continued to consolidate, and this market is anticipating Fed's reaction on the non-farm payroll surprise. And I think that is going to be crucial for the next week, but it's only going to be in the beginning of next week. That is not going to be influential throughout the whole week. So just in the initial phase, and then I think the markets might shrug it off. So it might be enough for a drawdown to cool off the markets temporarily. And then the dollar has strengthened end of last week, but this is also going to go hand in hand with how Fed's reaction. And then gold and metals consolidating. Believe they're charging for new highs, but they might go down and continue consolidating for a while. Wheat and cotton have started to build a bottom, and depending on weather and energy policies, the natural gas should continue its decline. And next week, it's not that much coming in, but I think we should keep an eye on Friday, where US gets its consumer confidence, and then also the UK is getting its preliminary GDP, and then China is getting inflation and PPI. So that is all for this week, so I'll see you guys next week, and have a great one.